Topic 2, professional liability. What is professional liability? Means if auditor is not performing its duty and there is anything like, let me give you an example. Auditor's responsibility is to obtain reasonable assurance that financial statements are free from material misstatement, whether due to error or fraud. If in case there is any material misstatement and if the auditor let go the misstatement, means auditor will not communicate or inform to the management or ECWG. It means auditor is not performing its duty. So if the audit report issued without changing or affecting the opinion, and the users of the financial statement will rely on such report, so it will result in auditor's liability. Now we will the content of professional liability. Negligence. There are two types of auditors liability. First one is unintentional. Unintentional means mistake or error not did deliberately. The second one is intentional. Intentional means auditor has an intention to do this negligence. How deliberately or collision with the management means auditor is in link with the management. There are no independence between the management and the auditor. Now move to how to prove negligence. Who is responsible to prove auditor negligence? It is the injured party. Who is the injured party? In case of company, injured party is the shareholder because auditor perform audit for the shareholder. Auditor is responsible for the shareholder. So injured party is the shareholder. Injured party means shareholder must have to prove three things. The first one is the duty of care enforceable by law exists. The second one, duty of care was breached. The third one is breached was lost. The first one, the duty of care enforceable by law means in case of auditor and shareholder, there is a relationship called agency relationship in which principal are shareholders and agent is the auditor because auditor works for the best interest of the shareholder. So the first case, the duty of care enforceable by law exists is easy to prove as while accepting the engagement, the auditor signed an engagement letter and in the engagement letter it is mentioned the auditor's responsibility and other things. So if anything is not up to the engagement letter, so it will become easy for the shareholder to prove that the auditor negligence. Now read the content. Shareholder versus the auditor. There is a relationship known as agency relationship, whereby the shareholders are the principal and the auditor is the agent. Point number two, in the case of shareholder, the duty of care by law exists is easy to prove. How? As this is more automatic and implied by virtue of Companies Act 2006. Now, point three, at the start of the audit engagement, an engagement letter is signed between the auditor and the client. Now, the second, which is duty of care was breached, means the shareholder must give evidence, documentary evidence, in the court to prove that the auditor duty of care was breached. The injured party means shareholder inform the auditor in the form of any documentary evidence that auditor has not done his responsibility. The auditor's negligence is intentional. Now move to the last point, which is breached cost law. The shareholder injured party must also inform the court or the authorities that the amount of loss which the shareholder affected due to negligence of the auditor. So based on that, the regulators or the court will take charge on the auditor. So There is a discussion point. The auditor report is addressed to the shareholders of the company. If you have seen the audit report, so the first element of the report is title of the report, means to whom the report is for. The first title of the auditor report is Independent Auditor's Report. After independence, the second element of the report is addressee, means to whom the report is for. In most of the cases, the report is usually for the shareholders in case of private company. In case of public listed company, the report is not only for the shareholders but also for the general public. General public are considered as stakeholders. Now read this discussion point. So shareholders are protected and shareholder can file a liability against the auditor if they prove auditor was negligent, means duty of care by law exists. And how this duty of care by law exists, it's easy to prove via engagement letter. Now come to the what about stakeholders. I have just explained who are the stakeholders who rely on the audited financial statement, even though the audited report is not addressed to stakeholders and there is no liability in contract between the auditor and the stakeholder. Let me give you an example. I work as an auditor and I have appointed to perform the audit of ABC private company. Now there are something which I have overlooked. Let's say few material misstatement which I have overlooked, and the opinion is unqualified or unmodified, means opinion which I have issued is unmodified, even though there are material misstatement which can change the opinion, let's say qualified or adverse. So in this case, the report is for the shareholder because I have mentioned that the company was a private company. Now move to the case 2. Let's say I have been appointed to do an audit of ABC listed company. Listed companies' financial statements are for the general public so that they can invest in the company based on their audited financial statement. So it means auditor is not only responsible for the shareholders as well as auditor is also responsible for the general public. So this responsibility of auditor towards the general public called liability in tort. Now come to the liability in tort towards stakeholders. Tort means auditor has a general responsibility, duty of care to conduct a good audit irrespective who relies on the report. Auditor will not have to think that it is for the shareholder or the general public. To protect their liability, auditor need to work diligently and with due diligence. Now move to the point 2, code of conduct ethics. Professional competence and due care. General due care, irrespective of who rely on the audit report. Professional behavior, exercise of behavior is general responsibility of an auditor. Exposure of liability in contract is narrow versus the exposure of a liability in tort for the auditor. The liability in tort general duty of care for the auditor and which exposes auditor are greater liability by any more. It means if the auditor is solely responsible for the shareholder, then the auditor liability is narrow, means auditor is limited his liability towards the shareholders only. But in case of liability in tort, general shareholders or general stakeholders, then the liability of an auditor will be broad, means it is not only specific or limited to the shareholders. There is another discussion point. Should there be a limit to anyone under tort, else the auditor liability will be unlimited. The budget for the current school year, oh sorry, this is a wrong point. Let me correct it. Okay, this discussion point is just the explanation, or you can say the summary of the above mentioned thing which I have explained. Now move to the Bannerman case. Okay, there is a very famous Bannerman case. It directly links to your practical exam scenario questions. I must say you guys should read the Bannerman case. In the Bannerman case, there are four things or five things. Let me four things, or you can say 4 points. Bannerman case versus stakeholders means verdict. The auditor knew the identity of the third party. How auditor limit his liability towards the general public. It means when the auditor is doing the assignment of an audit client, auditor should obtain an understanding of the client so that auditor can work due diligently. Now move to the point two. So that means when the auditor is planning the audit and is gathering knowledge of business, the auditor will come to know about lots of important stakeholders and their relationship with company and their expectation. This is just a point which I have explained. For example, the auditor know about the major banks of the company, the major customers, distributor, retailers, consumer or vendors, etc., the major suppliers. So these are the general stakeholders. Point four, auditor knowledge of business, known stakeholders versus unknown stakeholders. Known stakeholders, they are internal persons. Unknown stakeholders, there are some external persons who have indirectly stake in the company. So these are the four things which an auditor should obtain their understanding in order to protect its liability. Now come to the injured party. In case of shareholder, duty of care by law equal to Companies Act 2006, which we have just covered above. In case of non-stakeholder, duty of care by law equal to Bannerman case. In case of shareholder who is the injured party, shareholders are the injured party. But in case of non-stakeholders, who is the injured party? Duty of care by law is Bannerman case. It means there will be, in the Bannerman case, there is someone who is responsible to prove the auditor's negligence. Now move to the final perspective. The injured party, shareholders slash non-stakeholders, must prove auditor negligence to make auditor liability by following three steps below. Duty of care by law. In case of shareholders, it will be proved automatically via Companies Act, and in Bannerman case, it will be Bannerman case. You have to study the Bannerman case for better understanding. Point two, prove in the court through evidence by injured party means the injured party must have to submit the documentary evidence to the court to prove the auditor breach. The third is the breach cost law means injured party must also quantify the amount of loss which the injured party have suffered due to auditor's negligence. Okay, now the difference between unintentional versus intentional negligence. Unintentional negligence equal to civil liability. Civil liability penalties imposed on audit firm which they have to pay to the injured party. There are some unintentional negligence means by mistake or error. In this case, audit firm which have to pay some penalty or fine to the injured party. But in case of intentional negligence, it is a criminal liability which is very dangerous to the audit firm. Now read. Severe impact on audit firm future. The regulator can blacklist the audit firm or else the audit firm will be dissolved or liquidated. Example of Arthur Anderson versus Enron. This is a very good case. If you have time, you guys must go through. Now, this is a very important topic, limiting auditors' liability. How an auditor limit his or her liability? The first point is quality of audit work should improve because this will reduce negligence and overall exposure to liability. This is a proactive approach. It is obvious that in order to protect your liability, you should work actively and diligently, means there is no error of margin. Now, point two, UK approach only. In case of UK based client, there is a disclaimer of liability paragraph. It means if an auditor mention a disclaimer of liability paragraph in his report, so auditor restrict his report only to the shareholder, not for the general purpose. Let me give you an example. Let's say I am doing an audit of ABC client, which is a UK based client. Now I know that ABC is going to obtain a loan from a bank, and there are chances that the ABC may manipulate their financial figures to show the better position in order to secure a fund. Now, in order to protect myself, I will mention a paragraph of disclaimer of liability in report. After mentioning this paragraph, I must restrict my report only to the shareholder, not for the bank. Now, read from the content. The auditor can use a disclaimer of liability para in audit report subject to a liability limitation agreement with the audit client. The agreement with client important to use the disclaimer of liability para. Yes. Before expressing or mentioning disclaimer of liability paragraph, I must have to obtain a permission from the client. Why? Just read the reason. Example, disclaimer of liability. When the auditor uses a disclaimer of liability para in the audit report, it's worded like following. This report is solely for the company's shareholders. Suppose this is an example, or you can say the reason why an auditor should obtain a permission. Suppose the client which you are auditing is highly geared or is negotiating a loan from a bank which will be issued after the signing of the audit report. If the audit report mentions this audit report is solely for the company's shareholder, will it negatively impact the client relationship with banks being highly geared and the ongoing negotiations? Yes, and the client will not agree to the disclaimer para. In most of the cases, client will not give a permission. What if client will not give a permission? How will we protect ourselves? Still, we have to work diligently and with due care. There is no other reason. Now move to the point 3. Incorporated means an audit firm incorporated into a liability LLC company. In the past, it has never seen that an audit firm has done this thing. But yeah, it's mentioned in the AAA content, so we have to study. Incorporated. If an audit firm become incorporated, it will become a company. For example, PwC Incorporation. Price Water Corporation to incorporation means PwC firm becomes a PwC company. However, no audit firm to date is incorporated because even though incorporation have benefit of limiting liability, there are adverse impacts on audit firm of getting incorporated like adverse tax implication, and the audit firm by virtue of becoming will need to publish the FS and subject to audit. Once an audit firm becomes an incorporated company, then audit firm can't do an audit engagement, even though then the audit firm after becoming a company will have to do their audit from a third party audit firm. So it is not recommended. Now move to the point 4, LLP, Limited Liability Partnership. In case of LLP, the benefits of limiting liability have been taken and the disadvantage of the becoming company has been excluded. It means if an audit firm becomes a limited liability partnership, so the disadvantage of the limited liability company will not be there as audit firm becomes a limited liability partnership instead of limited liability company. Point B, audit firm mostly around the globe have become LLP in last 10 years. No personal bankruptcy of the partners when settling liability. So LLP is better instead of LLC. Now the last and fifth point, which is German only practice, means capping liability, fix the liability, unintentional negligence, the maximum the audit firm will pay if found negligence unintentionally. German only practice will only apply in case of unintentional negligence, means by error or by mistake. In this case, the audit firm will pay if found negligent unintentionally. In case of listed company client, 4 million euro as a penalty, or in case of non-listed client, 1 million euro as a penalty. Now, in this topic, there is only one past paper, which is Spaniel company. It's a very good question you guys must attempt, even though I will upload a suggested solution. Now, there is a one technical article, which is auditor's liability. You don't need to go through the complete article because it's a very lengthy article and it will take your more time. I just write a main crux of the article so you guys can read. It is a very good article which will further give you more idea. If you have any query or any suggestion, feel free to contact. Take care and goodbye.